It's panic at the top. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, global leaders brace for catastrophe as an unthinkable situation unfolds. And what I want to understand is this is something that global leaders do not want to do. In fact, they've done everything possible to avoid this, and now we're coming down to the wire that one country is going to have to make a very important decision that will affect every other country in this world, to the extent it will even determine what the Fed does going forward and have a significant impact, as you're about to see, on the U.S. economy. Now, for all this to make sense, we're going to start out by heading over to Deutsche Bank, where I need to give you some backstory and understanding to why this country is going to do the unthinkable. And yet, as you'll find out, it will affect everyone. And we have the headline: after 625 days, the longest yield curve inversion now in history. And this is an historic day, as Deutsche Bank's Jim Reed reminds us, we quietly passed the longest continuous 2-10s inversion in history after it was first inverted at the end of March 2022. That exceeds the 624-day inversion from August 1978, which previously held the record. And this matters in a big way, because a lot of people are now looking at the yield curve, which has this impressive track record of calling recessions, and seeing it doesn't matter anymore. It's because they don't understand how the global financial system and monetary system works. And because of this inversion, it's putting one major country at the brink of having to do what is the unthinkable. And this, again, will have global repercussions. Let's take a look at the yield curve. We use this chart on the show frequently. This is the 210s, which shows an inversion anytime the blue line is underneath the horizontal black line. And what that signifies is that 2-year rates are higher than 10-year. And in a debt-based economy, that is not normal. People normally should be compensated for risk and time. And when the curve is inverted, you don't see that happen. And the reason we see these inversions is because central banks have raised short-term rates, causing this inversion. Now, it's not just the Federal Reserve, it's central banks all over the world, which is one of these key points I want you to understand. Because in our banking system, the way it works is banks borrow at the short end of the curve, short-term rates, and lend at long-term rates. So when short-term rates are higher than long-term, they don't make money on the spread, and they start to curtail their lending activities. The second key point here is banks are the source, the only source of money creation in a debt-based economy. It's not governments when they borrow from the public. It's all about the banks. And here you can see the length of all U.S. 210s yield curve inversions that were longer than 3 months. The current one now heading the record. And yet, this is a time when global equity markets, at least in the U.S., are sitting at all-time highs. Many people believe we're at another bull market, that the U.S. economy is infallible at this point, that the labor market is strong and robust, that the Fed has nailed this perfect soft landing, maybe even no landing scenario. They've done the impossible, and yet we're not there out of this yet. As regular readers are aware, an inverted yield curve has been the best predictor of a U.S. downturn of any variable, though, and the yield curve has always inverted, key, always, before all of the last 10 U.S. recessions, with a lag that is about 12 to 18 months, but in some cycles, certainly this one, can take longer and much longer. And that's why we see all the risk-taking that we have in the equity markets, because the yield curve has been inverted for so long that people are now saying, hey, you know what? It's past metrics, its accuracy, it's gone. This is indeed the next bull market. The bond market is absolutely clueless about what's going on. And yet, as you're seeing here, this is going to set up a major move that's going to rock financial markets all around the world. In fact, the lack of recession so far has prompted Red to ask in his latest chart of the day note if the inverted yield curve recession indicator has failed this cycle. But in many ways, the yield curve has already actually predicted many of the drivers that would normally lead to recession. However, these variables haven't then created recessionary conditions as they normally would have done. It led, as it always does, the very sharp deterioration in bank lending standards. This is an absolute fact. We'll show you that on a chart here in a moment. And led to declines in bank credit and money supply, that are almost unique to this cycle. It was also at the heart of what we had some of the largest bank failures on record, with Silicon Valley Bank, Signature Bank, and First Republic collapsing. And guess what? More will come. A significant part of their failure was a big carry trade that went wrong when the curve inverted. So here you see the setup as the danger this is for the banks. And this also leads to another question many people have is, what if there is a recession? What if markets go down? Can I make money in those scenarios? And the answer is absolutely you can, because we give you the tools. We look at the machine positioning. We look at tacticals, and we do it in a very unique way. Here's some of our recent trades. Actually, this should be as a close of March 21st. But what we do is two things. We have two reports. One is we look at the machine positioning every day. A machine trades hundreds of billions of dollars at a time. And what we do is we show you when they are off sides in their trade. We show you these deep short positions, and we tell our subscribers on a headline report with all the machine positioning, so you trade with them, not against them. We give you videos on how to put the trades in. We do everything, and we put up some impressive numbers with that. We also have a report that trades the technicals. This is key because many people get in late and get out early. We smooth it all out with an overlying proprietary signal nobody else uses, and we give you all of those signals every day, plus the key ones to trade and a video on how to do it. And here's the best part. You can make money too. It's not that hard. We show you. It's very simple. You don't have to sit in front of your computer all day. You don't have to be a day trader. You put your trades in, go on with your day. That's the key. Jump in. There's a free month. My friends give you only 7 days. We give you a free month. Why? Because based on our reports, we know you'll pay for a subscription for a year and a month. How about that? Check it out, because let's talk about this curve inversion and the banks. This is critical to understand what's going on around the world, why this major country is faced with the unthinkable situation as a catastrophe is looming. And what you can note is now we have the 10-year, 2-year in red against the net percentage of domestic banks tightening lending standards for commercial industrial loans to firms of all sizes. And so what happens is when you get these inversions, the banks can't make money lending. So what they do is they start to tighten lending standards. And that means when you go in and ask for a loan, well, they say, here's all the additional requirements we have for you. And they make it difficult. They make it very hard, and they turn people down. And you'll notice that this happens every time, either during the inversion and throughout it. When what happens is when the red line is going up here, that means interest rates are falling. Banks actually don't like it because it makes it even more difficult for them to lend because the spreads are so tiny. But you'll notice what happens here, and this is a key point, is when the banks, as a source of money creation in a debt-based economy, curtail their lending activities, that means there's less currency in the markets. Now, again, I want you to think about this. Central bankers around the world, not just the Fed, have inverted their yield curves. And so what you should be thinking right now is, wait a minute, that means there's a massive money shortage that's going to hit the global economy at some point, and you've got it right. However, as Deutsche Bank notes, even with the above recession, according to the highly political, quote, recession authority known as the NBER, hasn't materialized because, well, when lending standards were at their tightest, the borrowing needs of the economy were relatively low compared to previous cycles. That could be one reason. I think the biggest reason here, the only one that really matters, is excess savings have been unusually high in this cycle, and that means consumers haven't been exposed to tight credit as they normally are. And so as banks were curtailing their lending activities and creating less money, well, there's already a lot of money in this financial system, which means it has to take longer for it to erode and eat away. Now we're seeing those signs now. And so far, however, an inverted yield curve should ultimately be a significant headwind for an economy. And it notes here, as capitalism, I should say a debt-based economy, works best when there is a positive return for taking more risks with lending and investments further out the curve. And that is absolutely correct. That is how the system should work. But central bankers, or man, steps in thinking they know better than the bond market and forcibly inverts the curve. And this then has, of course, as we talked about, repercussions around the world. And we're starting to see things break, putting one country now, as you're about to see, in an unthinkable situation to avoid outright catastrophe. As China jolts the currency markets, as yuan suffers the worst day in 2 months. Now, you might remember we've been talking about China and how they've been trying to prop up their currency endlessly. But one of the key things here in a debt-based economy, in a global economy, demand for your currency is about global trade. So why have we been seeing the yuan and other currencies go down in value? Because global trade is slowing. The global economy is slowing. Demand for their currencies is going down. And so what has Beijing tried to do? In many different ways, prop up the currency. And what have I told you? It won't work. In the short term, it might. In the long term, it won't. And sure enough, now they've got a problem because their currency is starting to fall, and that's not a good sign. The softening in Beijing stance underscores the challenges that policymakers face as they try to stimulate a fragile economy through monetary easing while also keeping the yuan broadly steady to prevent capital outflows. A decision to loosen control wouldn't be straightforward, however, as the PBOC will need to maintain some support to make sure that depreciation is orderly and doesn't endanger financial stability. And it does endanger financial stability because if the yuan loses value, what does that mean? That people have yuan. What do they don't want? They don't want it. They want to get rid of it. They want to get it out of the system. They want to unload it. Not good for China at all. And so we see the onshore yuan slid as much as 0.4% per dollar on Friday, breaching a critical level of 7.2 that policymakers have been defending for months. And so now we start to see where this catastrophe starts to happen. But that's why I wanted to show you what Deutsche Bank had to say about the yield curve, because what we've seen is central bankers around the world have constricted the creation of credit. They've slowed down the global economy. They've created currency shortages. And now China is actually seeing the first problem with this, as the yuan is losing value and all attempts to prop it up just aren't working. The currency was also driven lower as state banks refrained from selling dollars, again doing anything they can to prop up the yuan in large amounts at market open. Sentiment was further soured after the PBOC deputy governor said the nation still has room to lower the reserve requirement for banks, a move that may further widen the U.S.-China monetary policy divergence, suggesting, as markets always misunderstand, that just because banks lower the reserve ratio or the central banks lower the reserve ratio doesn't magically turn into money printing, because people still have to borrow. Money has to be created by the banks when they lend. Just lowering the reserve ratio doesn't automatically create that, but the market interprets it as it will and puts further downward pressure on the yuan, now seeing that it's going to continue to lose value. Now the other end of this is it puts upward pressure on the dollar. Of course, our subscribers know we've had some trades that we put out on that to our reports. Again, you could grab that. There is a free month. We give you a month. Why? Because we know that you'll make money. But let's take a look about the dollar here now against the yield curve, because what to understand is that when the yield curve inverts, you can see cases where the dollar declines in value, but that doesn't last, because as the curve steepens, this means as rates fall, eventually you know that the dollar comes screaming higher. In fact, we can look in the past to see, well, these inversions literally lead to a strong or rising dollar in every case. In fact, right now, the dollar remains rather strong, and this is a problem for the yuan, of course, because it's linked to the dollar. So the higher the dollar goes, the weaker the yuan is going. This is a problem that Beijing needs to fix in a big, big way. And that means they're prepared to do now the unthinkable. And here we see from Zero Hedges, China preparing for yuan devaluation as renminbi tumbles after the PBOC pushes it below key support levels. And the answer is yes, it can in a big way. And there's good reasons why China would want to do this. And you'll see how it'll affect, of course, Fed monetary policy, because it could test much lower too, especially if the yen keeps crashing, as B of A's Michael Hartnett writes in his weekly flow show. While central banks are tolerant of higher inflation, they're intolerant of currency appreciation. Well, that's everyone except the Fed, as you'll see. And then he shows that yen is trading at a 30-year low versus yuan, suggesting it's only a matter of time before China has to aggressively devalue itself to catch down to its exporting neighbor. So what's going on with China now is affecting countries around it, as you're about to see. So why does China have to devalue their currency? It's the only answer they have. And when they do that, it's going to cause interest rates around the world to decline. And that means yield curves are going to steepen and set the catalyst for the next recession. But don't actually think the Fed's going to balk at this. In fact, the Fed's going to love this in a big way. And meanwhile, as markets wait to see how much lower Beijing will allow the yuan to drop, traders around the region are keenly watching moves in the yuan as it had long been considered an anchor currency. Here you see the Australian dollar and South Korean won, both considered proxies for China's sentiment, continue to slump. And what does that mean? Demand around the global economy continues to fall. That means these countries are forced to do something about their currency because the yuan depreciation has negative spillovers into the low-yielding ones, such as the Korean won, Taiwan dollar, and Thai baht. We would expect offshore yuan liquidity could tighten. It bets against the currency accumulate further, forcing then again Beijing having to react here to avoid an all-out catastrophe. But again, we look around the world. What do we see? India rupee closes at record low as yuan slide ways. Again, you're seeing currencies decline in value, and this isn't because fiat is dead, and I know a lot of people think that, but that's not the case. It's just global demand for currencies is falling in a big way because the global economy is slowing. And a combination of dollar shortage and Asian currency weakness has triggered a short squeeze. Here's the key point. A combination of dollar shortage. And why do we have a dollar shortage? Because the Federal Reserve inverted the yield curve, which caused the U.S. commercial banks to curtail their lending activity and create ultimately fewer dollars. But then we'll turn to the UK, where there's a brief amount of hope. I'll show you why it's not going to last. Because the UK looks set to leave recession behind, but the currency says no, as the pound's worst week of the year is upending a $5.5 billion trade. And here we note that, of course, what we see here is a combination of political uncertainty in the UK and the risk of a stagflationary environment in the second half of this year will be negative for the pound, not to mention the global economy continues to slow down here, and this is critical. So what are we seeing is currencies around the world start to fall. Now, what does this mean for the Fed? It means the dollar is going to go up. And what doesn't the Fed want to do right now? It doesn't want to raise rates. It's the last thing they want to do, particularly going to the election. They believe the U.S. economy is finally getting where they want. They don't want to go too far. That's their biggest risk now. But one of the issues they have is with oil. And oil steadies a stronger dollar offsets tightening fundamentals. And here you can see, why does the Fed care about oil? Well, it's real simple, because when oil prices go up, as you see in blue here showing West Texas Intermediate, it usually means the dollar is going down. So think about this. If China devalues their currency, that, of course, would put upward pressure on the dollar. That puts downward pressure on crude oil, and that's a big thing. Of course, for the Fed, here you see in terms of dollar rallies, usually you see crude oil prices coming down. Not quite a mirror, but fairly close to it as things go in the market. So this is a big indicator here, and that means, of course, we know West Texas Intermediate feeds into gas prices. Gas prices highly correlated to the consumer price index. Here you see the CPI against U.S. regular formations, gas prices in red, both on a year-over-year rate of change. And you can understand now the Fed, the last thing they want to do is see a weak dollar. So if China devalues, what that does is kicks off all these other currencies appreciating in value against, of course, the global reserve. That's the dollar. The dollar goes up in value. That means crude oil prices come down. And there you go. You get the inflation issue starting to get fixed here in the U.S. without the Fed doing anything. Then on top of that, because China devalues their currency, you know what else they need to do? Start buying treasuries in a big way. That puts downward pressure on interest rates, which China needs to revive their economy, because if you understand how things are going, U.S. consumers are balking under higher rates. If China can drive rates down, get the U.S. consumer to start spending, they can revive their economy. So you start to get to the big picture here of why China has to do this. But there's risk here, because if this goes wrong, and it can, where you take out the U.S. economy with it. And here we can see, looking at the Philly Fed Manufacturing Business Outlook Survey, as we see a surge higher in manufacturing activity, at least in the Philly area. But look at underneath this, the employment index remained negative, continuing to suggest a decline in overall employment levels. But that actually is good news for the Fed, because a stronger dollar means fewer exports. Fewer exports means weaker, of course, U.S. economy and the manufacturing side. You get rid of some jobs, you bring inflation down. We know the Fed wants to see the labor market cool. And on balance, the firms continue to report a decline in employment, as the employment index rose 1 point to minus 9.6 in March, its 11th negative reading in a row here over the past 13 months. Most firms, 80%, continue to report no change in employment, while the share of firms reporting decreases 14% exceeded the share of firms reporting an increase. But get this, the average work week also fell from 1.4 to minus 0.2, suggesting a slowdown here. We look at new orders, they're up. Unfilled orders, they're stagnating. Delivery times are getting crushed to the downside. Things are just moving now. So look at this, number of employees down, work week starting to slow down. All this tells you a rising dollar will fix the inflation problem in the U.S. A likely chance it's going to take out the U.S. economy, because look at this. You see the Philly Fed manufacturing index in blue against the nominal broad U.S. dollar index in red. You see a rising dollar is generally bad news for the U.S. manufacturing sector. And if you see a dollar rally here due to a China deval, well, watch out below, because the situation isn't pretty. You notice that China is trying to avoid an all catastrophe here, and I think they're forced to devalue the yuan. Everyone will get excited that rates are falling, but it may mean at the sacrifice of the U.S. economy as the Fed sits back and does absolutely nothing. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.